Today, inside the RBA's rate decision policy sausage. Hello again, it's Martin North from Digital Finance Analytics World. Latest posts covering finance and problem news with a distinctively Australian flavour. Well, there is the old saying that whilst you might like the sausage, you probably don't want to see what went into it. And I think the same can be said about the RBA's rate decision as typified in the minutes that they released today. But I want to step through a few of the things that they discussed because it does highlight the precipice that we're looking over the edge of. So they said, turning to the outlook for domestic financial stability, members noted that households, firms and banks in Australia had entered what was likely to be a more challenging economic environment in a strong financial position overall. Many Australian households and businesses had established substantial savings buffers during the pandemic, and policy support had contributed to a strong recovery in labour market outcomes and private incomes. This, along with forbearance for some borrowers, had resulted in low levels of loan arrears. However, members noted that resilience across private sector balance sheets was not evenly distributed, and housing and finance asset prices had declined in 2022. While many variable rate borrowers were well ahead on their mortgage payments, pressure on some household budgets and business cash flows were rising in response to higher interest rates and higher inflation. And members noted that variable rate borrowers with low incomes, small liquidity buffers and high debt were most vulnerable to mortgage payment difficulties, although the share of borrowers in such a position was low. Many fixed-rate borrowers were also set to face large increases in their minimum payments when their fixed-rate term expired. Members recognised, however, that lenders had assessed borrowers' ability to service their mortgages at interest rates above those prevailing at the time those mortgages originated. And members discussed the reduction in loan-to-value ratios since the onset of the pandemic. Most borrowers had accumulated large amounts of equity in their homes, reflecting the large increases in housing prices over prior years and the small share of high loan-to-valuation ratio lending in recent times. These developments had reduced risks to the financial system flowing from borrowers encountering difficulties in their debt servicing capacity. Members noted that, in aggregate, the effect of rising interest rates and inflation were more likely to be evident in a slowdown in consumption growth over the period ahead, rather than a large spike in banks' non-performing loans. However, this outlook did not account for the potential for a large increase in unemployment, which would be problematic. Members noted that following a period of forbearance during the pandemic, the number of business insolvencies in Australia had picked up of late, including in sectors where cost pressures were acute or where balance sheets had been severely affected by pandemic-related restrictions. However, the recent increase in the number of business insolvencies had occurred from very low levels, similar to the pattern observed in other countries. Banks in Australia, they said, remained very well capitalised with high levels of liquidity. Large capital buffers meant banks were well positioned in the event non-performing loans picked up from their current very low levels. And non-bank lending for housing had been particularly strong. Members noted that while non-bank lending comprised a small share of system-wide credit and that had been little evidence of a decline in lending standards, it was important that lending standards remained prudent. Members discussed the continued solid growth of the Australian economy and noted that national income was being boosted by a record level of the terms of trade. The labour market was very tight and many firms were having difficulty hiring workers. The unemployment rate in August was 3.5%, around the lowest rate in almost 50 years, and job vacancies and job advertisements were both at very high levels, suggesting a further decline in the unemployment rate over the months ahead. Beyond that, some increase in the unemployment rate was expected as economic growth slows. And they went on to say that wages growth had continued to pick up from their low-level rates of recent years, although it remained lower than in other advanced economies where inflation was also higher. Many firms were seeking to raise their headcount, and the increased difficulty finding workers meant that this strong labour demand was likely to result in a further lift in wage growth in coming months. The board, they said, will continue to pay close attention to both the evolution of labour costs and the price-setting behaviour of firms in the period ahead. Members did agree that a further increase in the cash rate was necessary to achieve a more sustained balance of demand and supply in the Australian economy. Price stability is a prerequisite for a strong economy and a sustained period of full employment, they said. Given this, the board's priority is to return inflation to the 2 to 3% range over time while keeping the economy on even keel. Members saw the path to achieving this balance as a narrow one, clouded in uncertainty. Members carefully considered two options for the size of the increase in the cash rate, continuing with the 50 basis point increases of the preceding 4 meetings or announcing a smaller 25 basis point increase. The arguments for continuing with an increase of 50 basis points stemmed from the inflationary environment and risks to inflation expectations. Inflation was high, broadly based, and expected to increase further. Inflationary pressures had earlier proven more persistent than expected, and there were upside risks to inflation from the labour market, rents and energy costs. While wages growth had increased more rapidly in other economies where labour supply had been more adversely affected by the pandemic, Australia could yet have the same experience given the tightness of the labour market. If the board were to reduce the size of the rate increase, it would be the first to do so among advanced economies. This might in turn prompt an unhelpful reaction in inflation expectations and financial markets if the community came to question the board's resolve to reduce inflation. Ultimately, if upside risk to inflation were to materialise or the credibility of the path to reduce inflation came into question, it would be costly to re-establish low inflation. In this context, members also noted that the cash rate was not at an especially high level. Consumption had so far proven resilient to the increase in interest rates, supported by strong labour market conditions and the large financial buffers that many households had built up during the pandemic. The argument for a 25 basis point increase rested on the risks to global and domestic growth and the potential for inflation to subside quickly. The cash rate had risen by a significant amount in a short period of time. While consumption had so far held up, monetary policy operated with a lag, and there was a risk that household spending might adjust by more than expected. Higher interest rates, alongside higher inflation, were putting pressures on household budgets, and consumer confidence had fallen. The full effects of higher interest rates were yet to be felt in mortgage payments, and the increases in the cash rate were close to the interest rate buffer applied when many current borrowers took out their loans. The tightening monetary policy was having a clear effect in the housing market, where prices had declined after earlier large increases and the demand for housing loans had also fallen. Previous episodes of lower housing prices and turnover had seen a large effect on consumer spending, in part through the wealth channel of transmission. With regard to inflationary pressures, members noted that wages growth had not reached levels that would be inconsistent with the inflation target. Moreover, some further rise in wage growth would not necessarily be cause for concern, given the flexibility and medium-term nature of the inflation target, so long as inflation expectations remained well anchored. Institutional features of the Australian labour market also made a sharp rise in wages, less likely than in other economies, which would help smooth the cycle in wages growth until some of the tightness of the labour market lessened. External inflationary pressures might ease quickly, given that the global outlook had deteriorated and commodity prices had generally declined and supply chain pressures had begun to ease. Increases in policy rates in advanced economies were likely to entail a period of significant lower output growth, which would be important for reducing global inflationary pressures. Finally, members noted that in an uncertain environment, there was an argument to slow the adjustment of policy for a time to assess the effect of the significant increases in interest rates to date and the evolving economic outlook. Drawing out policy adjustments would also help to keep public attention focused on a longer period on the board's resolve to retain inflation to target. While some other central banks may have been increasing policy by larger increments, policy-making bodies in these central banks met less frequently than the Reserve Bank Board. Members acknowledged that the arguments were finely balanced, and they concluded, though, that the case to increase the cash rate by 25 basis points at the present meeting was the stronger one. A smaller increase than that agreed at preceding meetings was warranted, given that the cash rate had been increased substantially in a short period of time, and the full effects of that increase lay ahead. Members also recognised the benefits of a smaller increase, while the incoming data on both the global and domestic economy were assessed. At the same time, the board agreed on the importance of returning inflation to target and the need to establish a more sustainable balance for demand and supply in the Australian economy. This was likely to require further increases in interest rates over the period ahead. And they concluded the board will continue to monitor the global economy, household spending and wage and price setting behaviour closely. The size and timing of future interest rate increases will continue to be determined by the incoming data and the board's assessment of the outlook for inflation and the labour market. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that outcome. So 3 quick observations. Clearly, of course, the issue with regard to house price falls was there in the middle of the discussion. Clearly, they're concerned about the impact if prices fall too far and hard. The second point is they do recognise that it takes time for rate rises to percolate through, and that's what we're seeing in some of the interest rate rises for mortgage payments, for example. But thirdly, having set now a precedent of 25 basis points again, it's going to be very hard for them to accelerate back up to 50 or above if inflationary pressures start to get out of hand even more. So have they backed themselves into a corner? Well, I guess we'll see. If in fact inflationary pressures continue to rise and are more embedded, as we saw in New Zealand today, then it may well be that that was a wrong policy decision by the RBA. On the other hand, they can continue to do 25 basis point rises for longer. And of course, the bottom line is this: they are still saying the target of 2 to 3% is a critical target to reach, and that they will do what it takes to reach it. And that means more interest rates. And so those who believe that there's a fundamental pivot here and that the RBA is effectively walking away from its resolution to solve inflation, I think are incorrect. The RBA believes that inflation must be conquered, but the rate of trajectory of interest rate growth from this point might be a little slower, but the end point is still up, and possibly significantly up. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.